Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Gregg Gruehl. Gregg is with Gruehl Capital Management Partners, and we're going to talk industrial real estate today. So can't wait to dive into everything that Gregg's got going on. Gregg, welcome to the show.
Thank you for having me, Keith. Appreciate taking your time and being a guest on the show.
Yeah, absolutely. And I typically like to just start with kind of your background, Gregg. It's always interesting to me and hopefully interesting to the audience where you kind of grew up and what eventually led you to this profession of real estate investing and specifically industrial.
Yeah, so I would say it's been a long 80-year journey of my family being in real estate. So my great-grandmother got her sales real estate license in 1942. My dad actually just gave me a copy of that the other day, or the
Awesome.
actual document the other day. We're going to hang it in our office. My great-grandfather ultimately passed away during World War II, so that is how she made a living to support my then 1-year-old grandfather. So really, real estate's been in the family business for a long time. My grandfather went in and out of using his real estate license, but maintained one his entire life. Then my dad really took the major leap that got me into real estate, which after he graduated from college, he went on to be a commercial broker for his entire career of 40 plus years, focusing almost primarily on the retail side, working with his last clients, a large grocery developer throughout northern Ohio. But basically, during that time, I watched him go through his ups and downs of brokerage. And at 18 years old, when I was playing hockey still, he handed me a book called Rich Dad, Poor Dad. Most people have read it in this industry. Everybody knows it.
Yeah.
Then that kind of got my wheels turning at 18 to try and kind of understand that, look, I want to be an entrepreneur at some point in my career, but I want to understand the business at greater depth. So after my hockey career finished up, I went on to graduate from Ohio State with a finance degree, but ultimately wanting to go into real estate. Not wanting to follow in my dad's footsteps as much as the broker side because of the ups and downs of the income and how hard that was to get off the ground. I decided to work on the principal side. So I worked at several large public real estate investment trusts, one a large shopping center owner, one being a large industrial REIT as well, being my last role before making the jump to entrepreneurship for the last 5 months. So held several different roles throughout my time on the principal side. Was a management trainee, then an asset manager for a multifamily firm, then an asset manager for Link Logistics, which is Blackstone's largest portfolio company. And then went on to work for a large public industrial REIT named Stag Industrial, where I oversaw acquisitions in parts of the Midwest and in the Mid-Atlantic. And then that's where we lead to today. The last 5 months, I started this firm, GCMP, or Gruehl Capital Management Partners, with my brother.
Okay. And so you started that with your brother. First of all, great tremendous background, obviously. Real estate's in the blood for sure. So that's pretty cool. And, I'm sure just growing up, seeing your dad going through all those ins and outs of commercial real estate and the various things that he was doing help. Sounds like your brother took a role in some of this as well, since you're partnering with him. What was his route outside of school before you guys start partnering up on?
Yeah, so he actually followed a little bit more in my dad's footsteps. At 18, he got his license, as did I, but I did not utilize it. He really worked for my dad as a kind of an assistant broker,
Okay.
more or less doing clerical work, and then he started graduating to working on deals and finding land sites for out parcel developers, as well as my dad's main grocery client as well. And so he had a couple successful deals, but those paychecks were big lumps, and then they didn't came few and far between. These commercial developments, I mean, they would sign up a piece of land, and could take a year, 2 years for him to get paid. So he was like, "Look, I need to get a job." He went on to work for a home builder here in Columbus, Ohio, where he was ultimately very successful, as Columbus is a very fast growing city. And then he hit right at the right time during the COVID boom. So he was ultimately able to sell well over 50 homes in his time at the home builder.
Nice.
But during that time, it also took 17 months to build a house. So he was dealing with over 50 people in contract for 17 months, complaining to him about issues because of COVID mostly. And price increases and all these other things. So he kind of was burned out. It was a 7-day-a-week job, people texting him at 11 p.m. at night, people texting him at 4 in the morning, 7 days a week, just complaining to him. So it burned him out. He started his entrepreneurial journey well before I did, working in the residential wholesaling business, flipping business, where he has a lot of great connections, because one of his best friends is a very successful wholesaler out west. And so effectively, that's what he did for the last couple of years. He was pretty successful at it, I would say moderately successful at it, but was really doing a more like side gig style, not really any kind of major investment to like gas pedal that strategy. From there, when I left Stag, they basically, him and I decided, look, let's start out with this strategy. Let's utilize my relationships to go on to kind of back onto the commercial side. Let's look at development deals. Let's look at stabilized deals. Let's look at value add deals. Let's look at anything, right? Trying to figure out what we wanted to target, what worked for investors, what worked for the equity we could find. So over the last 5 months, that strategy has shifted and drastically changed, where we continue to iterate. Initially, the thesis was to do stabilized acquisitions, call it less than $10 million, to syndicate to the mom and pop investors, similar to kind of multifamily, where our minimum's like $50,000, and we provide that to people that don't normally have access to that, because they're typically investing in multifamily. Mobile home parks, self-storage is what they're typically seeing more of. You don't typically get the industrial deals. So we were trying to bring more of like a class B / low end class A small deals to kind of the masses, was our initial thesis. We've definitely since iterated several times, and I can get into that further.
Yeah. Well, that's cool. I mean, you guys both have a great background for this, and it's always neat to be able to partner with your brother. And so cool. Yeah. So tell us a little bit about that. So you initially thought you were going to, do some kind of like you said, Class B stuff, and kind of smaller industrial. And tell us what you ended up deciding to do and why.
Yeah. So we underwrote, I don't know, 30, 40 deals in our first couple months, just, for deals that I was seeing, call it $3 million, $5 million, found returns to be lower than desired for most syndicated investors. They're looking for a higher return. Person puts their $150,000 check in, that's all of their free liquid net worth, into doing that per year, right? In their one deal per year, they want to see a higher return. A lot of multifamily guys provide that higher return, usually through appreciation by making improvements to the properties, inflating rents, increasing rents, in other ways, right? where we were looking at a stabilized deal on an industrial where a lease might be in place for 8 to 10 years, growing at 3%. So you're looking at lower returns than the standard multifamily deal. So that didn't get people too excited. I will say that brings massive stability, though, being a lease with a company, and that automatically grows. So you don't have to put too much in place for it to work. So you're just collecting mailbox money as opposed to worrying if your leasing is going up and down or toggling your rental rates or anything, really. Honestly, asset management is very simple with those assets. But what we found with not being able to really gas pedal the capital raise, there are people that did like that stuff, but ultimately it wasn't also worth our time as a general partner or sponsor to do deals really that micro, just because it wasn't going to generate enough revenue for our business in the long run. So effectively, that led us down the route of trying to figure out development. Initially, we partnered with the developer, but they had terms that they wanted us to raise under, kind of providing more of like a hard money loan style, as like a second position, kind of a preferred debt situation for the investors, as opposed to preferred equity in a waterfall structure where you got upside. So really, it was kind of a capped return. And our investors that we had spoken to didn't like that either. So then we started looking for land sites, and that's as well as more value add deals where we could kind of get those higher returns into those mid to high teens or even low 20s on the development type deals on the industrial side. And so that's where we are today, where we're out with an offer on a land site, and we're also out on an offer on a value add site. Can go into a little bit of detail, but not a ton, just because those offers are still out, and I don't want any issues with those deals to come because I spoke too soon.
Yeah, I certainly understand that. And so, with just, I guess, on just generalities with respect to those, kind of what's the game plan on those, those two particular offerings?
So I'll start with the ground up development. It is here in Ohio. Plan is to build a 70 to 85,000 square foot, maybe 90,000 square foot building. My general thesis on industrial currently, the bulk space was overbuilt through the last few years, and there's a ton of bulk product, call it greater than 300,000 square feet, especially in markets like Columbus, available, even more so towards even larger, like million square footers. So my thesis is nobody has really served the little guy for a Class A asset in numerous years in several markets that we're targeting for this development strategy, is to kind of target like call it sub 30,000 square foot tenant. So the plan is to chop the building up into multiple tenants in order to get kind of maximum rental value as well. It doesn't help necessarily with the exit because you may not have as creditworthy of a tenant, but I will say it does help with rental rates, so that kind of weighs that out. Although it's a higher cap rate, your higher rents kind of mitigate that risk. So that's kind of the plan. We're in early stages. We haven't gone through DD on that. We're kind of going back and forth with the seller on the land. And then the other deal is a value add deal. There's 60,000 square feet existing with stable leases in place. They are below market, so the plan would be when they come up for renewal in a few years, the average lease term remaining is 3.5 years, so you can get at those rents pretty quick. They're about 25% below market on comparable buildings, so we feel that we could achieve, moving those rents on the existing building. But there's two different options of value add on this deal. One, you can do what's called IOS, which is industrial outside storage, so you can add a paved lot or a gravel lot. Most likely in this case, you'd add a gravel lot. Not very expensive, but you can generate a ton of additional NOI boost to the property. It doesn't it increases the value of the property, but not substantially. Where the other piece that you could do is you can expand the building by 45-ish thousand square feet. And so we're kind of weighing both options, and we're going to kind of discuss that with the equity partner that we're going in on this deal with, in order to discuss whether they want to take more risk to have more return, or if they want to kind of hit that, call it a double, as opposed to a home run with the development, but there's a risk on the development that you're just going to hit a sack fly. So, whereas the iOS is kind of like, okay, we can invest call it 600 grand and then definitely get, probably $2 million worth of value on. So
Right.
like it's kind of an automatic play. Um, so really it's looking for those opportunities, kind of juice the returns, like a stable industrial deal, like for example, the value add deal. That alone, if you do nothing, is like a 12 to 13 IRR type deal. You put on the iOS, you're looking at 18, 19% roughly. You go into development, you're in the low 20s when you already have a stabilized building in place as well. So that's kind of the differential on how those change. Obviously, those metrics are not guaranteed returns. Those are just kind of projected based on my underwriting. And in no way is that a solicitation for investment.
Yeah, yeah, I understand. Now, on the gravel lot that you could potentially add to that one, is that going to be something that the existing tenants utilize, and so you basically just kind of rewriting their lease so that it incorporates that for outdoor storage of equipment, that kind of thing, or what does that look like?
So that would be your initial go-to, right? If you hire a broker to list the iOS, that would be your first place. You might not even list it. You might just talk to the tenant directly when we take over the property, see if anybody has a desire for it. If they do not, what makes this desirable is the location of this property will allow call it a third party to lease this as opposed to one of your current tenants in the building. And there's a high demand for additional trailer storage is typically what it's used for, but sometimes you do get equipment storage. So effectively, you'll put down a gravel lot, put a fence around it if it's not one of the tenants, and then you'll lease it out to another party.
Okay, okay. Sounds like there's quite a few different options on that. And then, from a geographic area, where all are you looking, Greg, at these deals?
Yeah, so I sit in Columbus, Ohio, but my old focus region was Ohio, West Virginia, Virginia, Maryland, Delaware, and Kentucky. But we're not focusing all those areas. We are kind of primarily focused on Ohio, uh, all Ohio markets, Louisville, Kentucky, as well as Richmond, Virginia. Now we will look at other deals outside of there. As across my career, I've worked in California. I've met people across all the Western states, but it would really have to be advantageous for us to do something, kind of anything further than if we really needed to get there, we could drive to. I don't think I'll be driving to California for an industrial building anytime soon. So, we wanted to keep it close just in case, we were frequently traveling to the property.
Yeah, yeah, makes sense. And so, what are some of the considerations and things when it comes to obviously two different concepts here, but with development, what are some of the considerations and things that you're going to have to make sure to put into place in order to execute on that business plan?
Yeah, so my main concern when thinking about that building would be the lease up, as well as the what is going to be competition at the time. Whenever you're doing development, you want to understand competition, kind of what's in the pipeline to be developed, what other land sites are available that could also come online at the same time that may be in process. Kind of what other vacancies may come up in existing buildings as well as try to understand the demand drivers of the specific submarket, as well as the overall kind of MSA drivers. In this particular case, this one's on the east side of Columbus. And one of the big demand drivers on the east side of Columbus, as most people know, is that Intel's opening a multi-billion-dollar plant. So there's going to be a lot of new demand from suppliers and vendors wanting to service that Intel account there.
Yeah, anytime you get somebody big like that, you've got so many other, like you said, the vendors that are going to want to be positioned closely, and so yeah, brings a ton of. Are you seeing a lot of that right now? I mean, there's a lot of growth in Columbus area.
Yeah, so there's a ton of growth in Columbus, particularly on the Intel front to kind of, round that conversation out. There's been builders and developers out there already developing the bigger bulk product kind of to service that need, but we're trying to service a niche that really hasn't been hit. And the reason for, call it the flex or shallow bay industrial product not being developed really over the last, call it 20 years in Columbus, is because construction costs. So when you build a building, call it a bulk building. You could build some bulk buildings for $100 a square foot. You might be into a flex building for $160 a square foot. Well, the issue is the largest sale comp in Columbus per square foot is going to be about $165 a square foot across all industrial product. Now, that's also because rents historically did not have really a large spread from the, call it, sub 30,000 to the 100,000 and above. Nowadays, there's a massive spread between the two that are driving the rents higher, where if you apply the same cap rates or even discount the cap rates, you could justify comps that are closer, or sales potentially happening in the future of any new Class A, call it flex or shallow bay, being around $200 a square foot. So really pushing that value. But those currently don't exist. Now, I will say in Columbus specifically, the market, there's a couple developers building some stuff, but at very slow pace, and they will likely have brought these to market before and have sold them to buyers prior to us, even breaking ground potentially here. So, and knowing about these things is what's so important about going after these strategies when, from an outside perspective, industrial is kind of gate kept for most people because you can't find the information too publicly. You really need to understand that your exit and how you're going to exit, especially if it's not product that institutions are typically used to buying. I know when my time at Stag, we would never pay $160, let alone $200 for something in Columbus per square foot. But if other institutions and groups like Stag, start buying that stuff in Columbus, it only validates the strategy as you go kind of deeper into it.
Yeah. And maybe for the audience, what when you say shallow bay, what is the distinction there? What is a shallow bay industrial?
Bulk buildings are typically have certain depth parameter. Well, all buildings, an industrial building developed today is typically a rectangle, almost always. They might have a little office pod that juts out, but typically people aren't adding those anymore. They're usually in line with the building. So really you're looking, it's kind of shallow bay is kind of a moniker for smaller building, but really, we're looking at, call it sub 80, 90,000 square feet for the total building size. Suite size, realistically, our building could be taken down by a single tenant that is 70 to 90,000 square feet. We are not planning for that because that will also lower our rents. So we're kind of planning for, underwriting lower rents for the single building scenario, but for the ability to split the building into fours. So call that, on 80,000 square feet, that's, 4 20,000 square foot suites. So you need capital for office and demising walls and utility splits and all these things. So we're including the capital for 4. We're underwriting the rents for 1 or 2. So that way we can kind of marry the two and limit our risk depending on which scenario happens, ultimately boosting returns from whatever we actually underwrote. So it's kind of a hedge for underwriting.
Yeah. Okay. And what would be considered the bulk then when it comes to industrial, like bulk space?
So it depends. A lot of people have different opinions. Okay. But let's just say, you're going to look at a building, 150,000 square feet and up is going to, you're not going to see anything smaller than a 50,000 square foot user. That's really not bulk. I would say it's probably 300,000 square feet and above, because you're really not going to see a 300,000 square foot building split into anything less than, call it 100 to 150. Now, if you get a 250,000 square foot user, you may be left with 50 and you lease it, but that's not the ultimate typical case.
Okay. And who would be the end user for something like that, a 300 to 150? I'm sure that, I know there's a lot of people that utilize that.
Yeah, so you would know all the names. And this is the one thing that most people don't typically understand about industrial space is, like, even companies like Amazon would be a user for a 300,000 square foot building. Walmart, Lowe's, Home Depot, Target, you name it, Kroger, all of the bigger name, and then numerous other 3PLs that are bringing all of your product in from China, even T-Mobile, or, I've been through thousands of these buildings. I've been through the SpaceX manufacturing building in California because Link owned that, all the way to imitation crab meat that's in everyone's Crab Rangoon on Friday night. So really, it's everybody, anybody. But your typical 300,000 square foot user is more on the logistics side than the manufacturing side. Typically, the manufacturing buildings are usually a little smaller. But yeah, it's usually more logistics focused when you're in bulk buildings. Whereas like our 70 to 90,000 square foot building could be ultimately utilized by any number of manufacturing. It could be smaller 3PLs that are servicing accounts. So it's really dependent, or it could be, consumer, direct to consumer type people that are shipping products out of there, or have a storefront for tile for contractors or whatever. However, you can kind of basically anything that rolls through American GDP rolls through an industrial building or logistics building at some point or another. Those tenants almost never own the building. Some tenants do own some of their buildings. Like most of Amazon's buildings are leased. They're not owned by Amazon. And that's kind of the case for most large organizations. But most people don't even understand that, even when they work for those organizations, unless they're in the real estate department.
Right. And so like for this one, or the one that you're developing, if it's, and you said you're kind of targeting, and correct me if I'm wrong on this, but somewhere around 80,000 square feet.
Yeah.
Is that okay?
Yeah, I'd say that's the average, somewhere in there. Yep.
Okay. And what are some of the, obviously, so the building itself is pretty well a rectangle.
It's going to be a rectangle. Yep.
And then what are some of the features, whether it be the flat work, whether it be the parking, whether it be, the bays, what are some of the things that you're going to need to incorporate in that'll be important for potential end users?
Yeah. So, in this particular plan, we'll spec one office. We won't spec all four, just in case we do happen to land the one tenant.
Okay.
And then that allows a little bit of flexibility for the future tenants. But if we do lease up the one that has the spec office and it's not going to take up the whole building, we'll put up the demising wall and we'll probably spec a new office at that time. Just so there's always kind of one ready to go. If we get down to our last suite, we'll probably spec that office as well. So office is important. You typically...
How big is the office?
You're probably between 1,500 and 2,500 on suites this small. So I would guess we'll spec and decisions haven't been made because we're, in negotiation on the LOI, but let's just say it's probably 2,000 square feet, which 10% is large when you compare it to bulk buildings. They're typically much smaller. You probably don't get much more than 5,000 to 10,000 square feet. So the percentage of office is much higher. So that leads to increased costs as well, which hence the higher construction costs for the development of these smaller buildings. So office being one, dock doors, and dock packages. Now, these are smaller users, so you probably don't need to, have too high of a dock count. You probably, let's call it each suite. Let's say we do split it into 4. You're probably looking at 3 docks and maybe a drive-in at most. That might even be high. It could be 2 docks or 1 dock even and a drive-in. It really just depends. We'll probably spec somewhere around 1 drive-in and 1 dock door with knockouts, so the ability to add more if we need to. So you kind of just punch the concrete out and put a new dock in. So effectively, those are kind of, and then typically tenants will also care heavily about power. What I will tell you is, in the building this small, we're probably likely going to service it with a general kind of power, 2,000 amps for the building. But I will tell you, there are some users, even in 30,000 square feet, that might use a lot more. And those would be your manufacturing users. Logistics users kind of use standard power.
Okay. And so is that something that can be retrofitted after the fact if somebody is a manufacturer, or does that pretty well need to be known up front, or is that an expense passed on to them?
It depends. It's all negotiable, man. Right? Yeah. I would say on a building this small, we'll probably spec it at a certain number and plan for a certain number. If the full 80,000 square foot building user comes along and they happen to be a manufacturer and a heavy power user, we'll probably cost share to some degree to land the tenant.
Yeah.
Because at the end of the day, that'll affect cash on cash of the initial return, right? Because you're giving out more TIs, so your ROI, your IRR is a little bit down, but the exit will be juiced because we landed a tenant at a higher rent because we gave them more TIs. So, it's kind of, it pushes and pulls.
Yeah, makes sense. And one more question, and I hope I'm not get too far in the weeds on this, but just on so like on the dock doors. So when I look at that, or when I think about it, are dock doors typically the ones where you're going to have the ability to pull an 18-wheeler up where it, basically is level with the slab so you can roll product on? Is that pretty well what a dock
So
door is?
yeah, that's
Okay.
correct. So dock high loading, it allows you to drive a forklift right into it. So whenever you
Okay.
tour these industrial buildings, that's a must. The drive-in doors are so they can effectively, most drive-in doors are utilized when they first move in to move in different items like racking or other equipment that they need. But they aren't as heavily used, or they might be utilized by the UPS driver or something like that. But yeah, dock high loading is typically reserved for the big 18-wheelers, 52-foot trucks. And a lot of times, like in Amazon's case with vans, they will have van facilities where they'll actually drive the vans into the building utilizing the dock high or the drive-in doors. But that's not how we would design this building here. It would be more designed geared towards some trucks, as well as I would say in the smaller space, you always also get a lot of box trucks that are more similar to the Amazon vans, but box trucks still can have some dock high loading qualities, so you can pull right up to the dock as well.
Okay. And is there ever a opportunity? And I'm just wondering from, as you mentioned, well, we'll probably have, depending on the size, 3 now, maybe we'll have some that we can, uh, I forget how you put it, but where you can knock the concrete out and continue to
So the
build.
knockouts, I mean, if you look at if you call it 20,000 square feet, you'd only have so much. You'd probably only have enough for literally 4 docks if you maximized it. You would never add that many punch outs to a space because you're not likely going to need more than 3 no matter what on 20,000 square feet.
Okay.
Because if you think about the entire building, 80,000 square feet, if you had, I guess that would be 12 docks. I mean, that'd be a pretty well docked building. You'd be looking at a logistics user if somebody requested that of you. And the good news is you can move kind of quick during TI build outs, especially if you have to build out the office to do the punch outs and add the docks as needed. They're just not a cost you want to take up front because you might get a user that only needs 1 dock, and that might be a TI package for the next user that you include on the next lease, because the guy doesn't need it. Whoever it is doesn't need it. Whatever company moves in just says, yeah, I only have 2 trucks a day, and that's it. And there's a lot of businesses like that.
Okay. Are there any setups ever where you've got say you've got 4 tenants and you've got one of those dock doors and it shimmed between the two, or is there never a cross of the
No,
product?
I mean, you could see some of that kind of stuff in older product where the building, I like to call Frankenstein buildings, where they kind of put them together, put up demising walls in different ways. But in this case, everybody's kind of designing the same thing as from a development standpoint in industrial these days. It's your standard rectangle. The demising walls bifurcate, where each one are. What could potentially happen, sometimes you'll have the demising wall jut out and cover another dock door. Say somebody needed 5 dock doors, but it'd get a little funky on the square footages, so it wouldn't split up nice. Like let's say on 20,000 square feet, it really wouldn't. You'd end up with 23,000 square feet and 17,000 square feet in another suite, and it'd be a little funky bump out from the other space to utilize the dock. You see that less commonly, but you do see that sometimes.
Okay.
But never connected.
Yeah. No,
there's too much liability between these companies for whatever their product is. Security reasons, you wouldn't want any reason for connection.
Yeah, makes sense. How about from obviously tremendous amount of square footage in the warehouse space? Is any of that heated and cooled, or what does that look like with? So obviously the office would be, but
yeah, so the office is heated and cooled. Typically, let's say in Ohio, you will heat the space, but you don't necessarily have to cool the space. That depends on the tenant. Those buildings can stay pretty good with circulating air, and what are called, and I apologize for the name, but Big Ass Fans is the name of the brand. And they're massive 20-foot blades, and they circulate air very nicely. And honestly, in a hot summer day, you wouldn't even know it's hot outside. It'd be, in the 60s or low 70s in there just by utilizing those fans, because the buildings are so large, they don't take on as much heat as they used to. So you don't typically have to air condition the building. Now, I will say, on one of 4 tenants, you might end up with a tenant that requires that. Now, that's where you can negotiate that into the TIs. You can give it to them as part of their deal. You can put it back on them to pay for themselves fully. There's all kinds of different ways you can manage it and maintain it. They can manage it and maintain it. There's kind of really, any way you want to slice the pie, you can.
Yeah. On a situation where they want it cooled, other than, I obviously think, produce and that kind of thing, is there, from a cold storage, that's like a totally different animal in itself, isn't it? I mean, that's just not, you're not just putting in an air conditioner,
No,
there's got
yeah,
to be extra insulation.
there is extra insulation. The floor slab is different, so your whole slab is different. Typically, people who buy standard industrial, they don't typically kind of go both ways. Some do. Individual operators might, but on the larger side, the public companies don't, because they like to stay to one strategy and one. They are
Yeah.
industrial in nature, that they're, your typical rectangle building, but they do require very specialized equipment, very specialized leasing, harder to comp. You're comping more. You wouldn't be comping, let's say, the food user is looking in the Midwest. They wouldn't just necessarily be looking in Columbus, because Columbus may only have one freezer cooler building available, or they're going to ground up development. But if they're looking, they would probably look at that requirement in Indianapolis, Pittsburgh, Cleveland, Cincinnati, whatever hits Louisville, to see what fits their build. So your comps would be spread across those markets. So vastly different rental rates. So people, it's not where we're going to be focusing our time. I mean, if a deal comes across the desk that might be interesting, maybe, but that's not also typically a smaller building. Those are typically larger buildings.
Okay. And I guess, if you could, Greg, tell us a little bit about, you and your brother's strategy moving forward. I mean, obviously you've got these 2 deals going now, and certainly we're going to give you an opportunity to tell the audience, how they can find out more about you if they'd like to get involved. But if you could just kind of maybe paint the vision of your company and, over the next 3, 5, 10 years.
Yeah. So the goal would be, our ideal situation now, having kind of iterated through the last 5 months, is to continue chasing land sites. We've actually, that's where we're spending most of our focus. I will say we still are looking at deals sent by brokers, still reaching out off market on buildings that have extra land pieces. But our ultimate focus on this side of our business, the industrial side, is to find land pieces, because we've made some great relationship with development partners, as well as equity partners that like the development play. There's a couple different ways to look at development. You can be kind of the opportunistic developer who's developing, stabilizing, and selling. Call it less than 36 months from start of project till completion and exit. There's another scenario where you hold it long term. Original equity stays in the whole way through. There's another where you refi out. Kind of in the rental space, you'd call it burring. But in this space, people typically just say, recapitalize an equity. We kind of have different views on that. Our couple of our equity partners want to move in, move out. Some of our development partners want to be in and out. Some of our equity partners would like to stay in even after the developer's out. So we'll recap out their equity, and then we'll stay on as asset managers over the long run, which was our initial theory on how to, kind of make reoccurring revenue for this business as well, is to actually build a long-term portfolio where we can hold and sell as well. So that's kind of the long, call it 5-year plan, is to take some of these developments we're doing with developers that are opportunistic and kind of want to exit quickly, and we'll buy them out of the project with new equity, or recap them out through the refinancing and hold through the long term to be able to take advantage of, depreciation benefits or opportunity zone benefits and the like. It really just kind of is dependent on a lot of scenarios, whether that's the investor, the developer, or the project.
Yeah. You mentioned something there too. And I think maybe for the benefit of the audience, because I think there's just some tremendous, especially when you're looking at land versus maybe an existing project. I mean, I guess it just kind of depends on an existing project if you can, double the investment amount. But talk a little bit about opportunity zones, if you don't mind. Are you guys specifically targeting any of that, or?
So we are not directly. We've been brought one opportunity to date that is in an opportunity zone. It's hard to peg returns because it's kind of like telling somebody how they're going to plan for their depreciation benefit in your investment, and you don't really want to get into that. You push that off to the CPA.
Yeah.
So, you typically underwrite that to a standard return and say, hey, look, this is an opportunity zone. So all the tax, you're getting a complete tax write-off here. We didn't particularly love the idea of that deal because it was too thin if you did try to do it opportunistically. So what I'm looking for is max flexibility. So I want the ability to sell in 3 years, even if we want to hold for 10.
Yeah.
Right.
Yeah.
Because I want to understand, whereas that opportunistic deal only worked if you kept it an opportunistic deal and you had long-term capital that wanted, call it low double digits or even single digit IRR yield returns, but was getting a massive tax benefit that, actually juiced those IRR returns up on the back end that I can't, quantify for each individual person's tax, situation.
Yeah, no, makes sense. Makes sense. So it's a little bit, it's a different strategy, especially if you got people that are, as you described, some want to get in, some want to get out. You just can't deliver that with.
Yeah, the opportunistic zones for industrial, like that project in particular that we're speaking on, in order to take the full benefit of the opportunistic zone, you had to hold it for 10 years. So there was and the returns weren't so great that I was like, okay, yeah, I'm going to be able to raise this capital really easy to partner with you on this. And quite honestly, like I didn't necessarily believe in the leasing that they did, that the developer put together and the underwriting. So when I re-underwrote it, I was like, this is way too thin for me to be comfortable pitching to investors.
Yeah. Yeah. Makes sense. All right. Well, yeah, it's exciting stuff for sure that you've got going on. Maybe if you want to take a minute and just, let the audience know how they can find out more about you, how they can connect with you, and kind of be there to be able to see what if they want to get involved with one of your current deals or something that you have in the future here.
Yeah. So my number one platform, my number one social is LinkedIn by far and away. It's just my name, Gregg Gruehl. As well as you can directly email me at greg@gruehlcmp.com. Also, you can go to our website, gruehlcmp.com as well. You'll find both my brother and my contact information there if you want to reach out. Always happy to connect with new partners, new investors, new brokers, new lead sources. However, you want to join in the community and build a portfolio with us. We're always happy to speak to new people.
Yeah, absolutely. Cool. All right. Well, this has been really, really interesting. And I got a couple other questions that I ask every guest. One would just be, any advice you might give somebody who's just starting out in their investment journey.
Yeah. So, I mean, unlike most people, your typical podcast probably has a lot of people that are already owned assets and they kind of made this jump from a different realm. I kind of took the realm of get educated by the smartest people in the room that I could possibly find, by going to the principals in the institutions. I will say that's not 100% necessary. My brother did the exact opposite and we're sitting in the same room together, right? So I would just say, honestly, having gone through the first 5 months of this entrepreneurship journey, just go for it. Go after what you want out of life because this is the only one you got.
No, I love it. That's great advice. How about a book recommendation? Doesn't have to be real estate related, but it certainly can be something you've read that's been impactful.
Yeah, so I've been a large book reader my entire life. Obviously I kind of mentioned Rich Dad, Poor Dad. I've read all of those, all of his books, but I would say that was very influential in my life. But ultimately for the audience to understand who I am and kind of how I approach life, I've thought about this kind of beforehand, and the book I would like to mention is Can't Hurt Me by David Goggins. And now that's, probably off the cuff for normal advice on this one. But this is one of those ones to get up off your butt and get moving, really, and it's kind of goes along with my advice to just do it, just get after it. take the risk because, it's so worth it. Whether and I wouldn't even call it failing. I'd call it just another attempt. So that's just go try something, push yourself out there and put yourself through hard things to get to that next level. Because when you feel uncomfortable, that usually means you're growing.
Yeah, for sure. Yeah, I know. What does he say? I forget what percentage he uses, but he's usually like, when you feel like you can't do any more, you're probably only at 30% of what you're capable of. It's
Yeah. Well, yeah, in his mind when he's running 200 miles, yeah. Okay, so what I will clarify there is I am not somebody who is running 200 miles. I'm not an ultra marathoner. I do like to work out early in the morning, as you guys will all see on my LinkedIn and anybody that checks it out.
saw it this morning.
But I am not running ultra marathons. I will say I like to push myself past the limits. And that's what we're trying to do here at Gruehl Capital as well.
Awesome. Well, this has been great, Greg. I appreciate it. And I think we'll call it a show.
Awesome. Thank you, Keith.
Yeah, thank you.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.